Hello everyone. Good morning, good afternoon, good evening, depending upon when you are listening to this audio lecture. In the previous session, we have discussed about the concept of income, what the income can be and what the income cannot be. And we also understood that definition of income and concept of income are different. Definition gives the list of various incomes which are taxable under the Income Tax Act 1961, whereas concept of income gives us an understanding of what is the nature an income should exhibit under the Income Tax Act, if at all it has to be taxable. So the Act will never tell us concepts, it gives us definitions, whereas the concepts are the ones we derive from the essence of the entire Income Tax Act. That is why at this level where we are starting the journey of learning the income tax, knowing concepts thoroughly and also having an understanding of key words, key terms, and some of them which have been defined in the Income Tax Act also becomes very important. And that's what we are going through as far as this series of audio lectures is concerned, particularly in relation to the concepts and the definitions of Income Tax Act, understanding various terminology. Now, coming to the income concept, there are many things that we discussed yesterday. Should the income be in cash only? Can it be in kind also? Should it be in monetary form or can it be in any other form also? The answer is, it is okay for the income to be in any form. Income Tax Act does not distinguish between income earned in cash and income earned in kind. So both are similar, both are same. There is no need that income has to be in cash form or monetary form. Even if something is earned in kind, still we can call that as income. However, since it is not a monetary item, we have to convert that into monetary terms. Imagine somebody has received, let us say, a gold ring as fees from one of his clients. We cannot say it is not an income. It is not a gift under normal parlance if it is received in the course of his profession or business. So, how to take gold ring into assessment? We have to take market value of that gold ring when such ring has been received by the SSE as if it is the income of the SSE, even though the remuneration, fees, whatever the name we call, the revenue, income that has been earned is not in the money form, still it becomes taxable, still it is included in the income of the SSE. So, income earned in cash form or income earned in kind, both are same in the eyes of Income Tax Act. There is no distinction shown by the Act. That is the very important aspect. We will see the application of it later. And some of you might be already thinking, sir, how can we know the value of the gold ring sitting at home? Please don't bother. Nobody is going to ask you or me to go and value the gold ring. That value will be given in the question if it is required. So, we are only doing whatever the provisions of the Income Tax Act are telling us. As far as calculations are concerned, valuations are concerned, that is none of our business. That will be given in the question. Data has to be furnished to us so that we can compute the income. We are not going to do any research on how an SSE has earned the income. All those details will be and should be given in the question. So, the essence of this concept is income earned in cash or in kind, both are same. Income Tax Act does not distinguish them. Same way, if the income is received from a permanent source or temporary source, doesn't matter. If the income is received in lump sum at a time or it is received periodically as installments, doesn't matter. In all cases, it is still treated as income. For example, if the income is earned through illegal modes, still doesn't matter. It is treated as income only. Imagine if the income is earned by somebody by stealing it elsewhere, doesn't matter. Still, such embezzled money will also be treated as income. So, any income, whether in cash or in kind or temporary or permanent, whether it is coming in lump sum or installment, whether it is disputed, whether it is illegal, whether it is by way of embezzlement, all these incomes are still considered as incomes. Still they are all taxable under Income Tax Act. So that is the essence of some of the things which are considered as income. And some other considerations also we have taken where certain things are not considered as income. For example, if an income is already taxed in the hands of one person, the same cannot be considered as income of other person since the income has already been taxed in the hands of the first person. For example, if a firm has earned some income and the partnership firm has already paid tax on the income that it has earned, on the same income, on the profit which has been shared by the partners of the same firm, on such share of profits by the partners, there will not be any additional income tax. Why? Because it is the same income which has already been taxed in the hands of the firm. So same income cannot be taxed twice. Is a general rule. Once again, don't jump to conclusions. General rule, yes, it is telling us same income cannot be taxed again and again. Common sense. Examples. 1. Share of profit received by a partner from the partnership firm. Second, share of profit received by a member of HUF from the HUF. Both are not incomes in the hands of partner and member of HUF respectively, since the same incomes have already been taxed earlier in the hands of firm and HUF respectively. So that is where income is not taxable under certain circumstances. Not only that, if there is an expenditure which has been incurred by somebody and all that he is receiving is as a reimbursement of such expenditure, that cannot be called as income. That is also a common sense point. The income means there should be a benefit additionally. If you already incurred some expenditure, you are getting it back. That is what is reimbursement. How can that be income? That is not considered as income. Same way, pin money or pocket money received by the spouse of a person, or for that matter children also, is not an income in the hands of the recipient. Same way, contingent income is not an income. Contingent income means the income which might be received in future, might not be received in future also. We don't know. Uncertain income which is in relation to future cannot be treated as income. So very important point this also conceptually, which tells us in order for an income to be subjected to tax under the Income Tax Act, such income has to be real. It cannot be fictitious, it cannot be futuristic, it cannot be contingent, and it should be existing and real, not fictional. That is a very important point. So maybe there is a possibility of you earning a benefit in future. Because of that possibility of earning a benefit in future, you don't need to pay any tax now. And assessing officers, if they ask any such tax to be paid by the assessees on the incomes which they have not earned, which they may earn in future or may not earn in future also, because future is always uncertain. So such contingent income cannot be called as income, that is not to be subjected to tax. Once again, it is a general principle. The law never said any of these things. Law never used any of these words: illegal, disputed, pin money, embezzlement, contingent income. All these things are never told by law as it is, whether income is received in cash or kind. Income Tax Act is not interested in telling these things. These are the essence. These are all the points that have been taken from the essence of the Income Tax Act, or not only Income Tax Act, various court judgments also told these general principles to be followed while making some income taxable under this act or not making some income taxable under this act. So what are the things which are considered as income, what are the things which are not considered as income, is the essence of this you can say the topic, features of income, or we can even call it the concept of income. What are the features of income in order to be an income, and what are the features of something which cannot be treated as income? Both of them have been listed in that table. You have to thoroughly go through that table consisting of features of income. And in this table, in the earlier session, we have not touched upon two things which we postponed to the current session. One of them is the concept of mutuality, or we can say the income earned by mutual activity. And another one is the tax-free income. These are all again both concepts, though the mutuality concept is one way has an exception which has been mentioned in the law. So normally the mutuality cannot be taxed, but exceptions to the general rule will be mentioned in the law definitely. So all the things that we are talking about in this table are general principles. Generally double taxation is not possible. Are there not exceptions? Yes, there are exceptions. We will see them in future. Similarly, normally there is no distinction between the legal owner and the beneficial owner. So both are okay. Is there any exception? Yes, there are. So that we will come to know in the clubbing provisions or the income from house property related topics. Like this, general principles are there at their place. The law, if it tells us any exceptions, naturally those exceptions will also be applicable. So what we are trying to know here is, for majority of the other things, general principles. But when it comes to the concept of mutuality, in the same table, we have the general principle also and we have exceptions also. So this is a very possible theory question that can be expected in the examination. What is the concept of mutuality? Is mutuality also subjected to tax? Or we can say, can income earned by the SSC by way of mutual activity be subjected to tax? Answer is no. It cannot be taxed. Why? Because it is not considered as income. For that, to answer why, we have to understand what is mutual activity first. What is a mutual activity? Mutual activity means an activity where some people contribute to the common fund and are entitled to participate in the fund, and the surplus arising from there. So some people are all contributing to a particular fund, and those are all members of that fund one way, and they are also eligible for surplus arising from such fund. If that is the case, we call that there is a mutual activity. And a very important point here, such surplus cannot be termed as income. That is the point here. Surplus, whatever is arising from this mutual activity, cannot be termed as income. That is why mutuality cannot be taxed. That is the core point related to mutuality. Now let us understand this with a simple example. Let us say 5 friends wanted to go for a trip, and each of them contributing 20,000 rupees each. On a whole, in total, they have collected among themselves 1 lakh rupees. After the trip is completed, it was found that actually they spent 90,000 only. Means still there is a 10,000 rupees surplus which they did not spend. Now the question comes, is that 10,000 rupees a profit? Of course, in this case, they did not form any organization. Imagine they formed an organization. Of course, nobody will form an organization for a personal trip. Only imagination. If at all, they have an organization and a body of individuals, let us say they have formed for this trip only, and then contributed 20,000 each. Then that body of individuals has resulted in a surplus of 10,000. Now the question comes, is that 10,000 rupees taxable in that body of individuals, in the hands of the body of individuals? Or if that 10,000 rupees is distributed back to them, say for 5 people 2,000 each, is that taxable in the hands of that person who is receiving it back? That 2,000 rupees, is it an income in the hands of the person who is getting it back? In both cases, the answer is no. Why? Because it is their money only. It is their money they have contributed to whatever the body of individuals they have formed, and it is all towards the same common purpose for which they have contributed. And each one of them is the beneficiary of that fund, whatever is formed for this particular purpose. And finally, because the individuals who are contributing and the body of individuals cannot be treated as different as far as Income Tax Act is concerned. That is the reason, if 5 of these people have contributed to a body of individuals which has been formed for the purpose of a trip, whom they are contributing to in a sense? In essence, they are contributing to themselves. That body of individuals is not a different party. It is also the same organization which is equivalent to all of its members. So, in essence, in a simple words, that body of individuals and individuals are not different. They are all one and the same. But then a question comes, sir, we only know that body of individuals is a different person. Nobody is denying that. Yes, that body of individuals is a different person, and the persons who are members of the body of individual are different persons. In that there is no doubt. We are not talking about whether somebody is a person or not. We are not talking about whether somebody is an SSC or not. That discussion is over. We are talking about whether such income or such money that has been received by such body of individuals from its own members, if it results in a surplus, is that surplus possible to be called as an income? Answer is no. Why? Because that is a mutual activity. So, when each of these individuals contributed 20,000 rupees, why they contributed, to whom they contributed, even though it looks like they contributed to another organization, in essence, what they did is, they contributed to themselves. It is their money. They just pooled it and spent it on a common ground. Just because they have pooled it and spent it on a common ground does not make it income of such organization. That is what is concept of mutuality. We can extend this to any other organization. For example, take ICAI itself, Institute of Chartered Accountants of India. Let me once again warn you, when we take examples, we are taking examples for understanding purposes. That does not in any way mean we are talking about the taxability of incomes in the hands of ICAI. No, that does not in any way mean we are talking about the taxability of incomes of body of individuals. No. When we took the example of 5 friends joining together, going for a trip, that's it. That example is only applicable in that case. Don't extend it beyond the example. That is where the problem comes in this subject. If you extend it beyond where it is applicable, then the problem comes. So you have to just stick to whatever the example we are talking about, and why the examples are being taken, only for understanding the provision. Once again, examples are supporting the provision. Provision will not give us any examples. Provision just says, the law just says, Baba, if there is a concept of mutuality, nothing is taxable, okay, go to hell. Then our job is to find out, boss, what is the concept of mutuality, when it is there, when it is not there. That is where we have to break our heads. That is the purpose why we are having all the examples, for understanding what is that concept of mutuality. Once again, not to create our own examples of concept of mutuality. No. That is not our purpose. We are just understanding the concept of mutuality only by taking examples where it is present. ICAI is also such an example, Institute of Chartered Accountants of India. Logically speaking, legally speaking, is it a different person or not? Absolutely yes. Are the members of ICAI, who are basically the chartered accountants, who are all the members of ICAI, are they different persons or not? Absolutely yes. Approximately, let us say there are 3 lakhs members in the ICAI. There are 3 lakhs different persons on one side, and there is one person called ICAI on the other side. This is the legal difference between ICAI as a person and all the individuals as persons. That is different. That's what already we discussed. Now what we are talking about is not the status. Now what we are talking about is taxability or not taxability. Now we are talking about is income of ICAI. So annually what happens is all the members of ICAI will contribute certain amount to ICAI. It's not a donation. It is a membership fees. Every year, every member of the Institute of Chartered Accountants of India has to pay an annual membership fees to the institute, and institute collects it. Of course, since it runs into thousands per member, and since there are lakhs of members, the overall fees collected, the membership fees by ICAI will run into crores of rupees, no doubt about it. And that money will be spent by ICAI, some of that in the welfare of the members, some of that for running the branches, some of that for the payment of salaries to the staff of ICAI, and of course, some of that money is also spent in creating content for the benefit of members in the form of monthly journal or other activities which are helpful to the members. All these expenses are there. Once again, we are only taking an example. No way it reflects the real numbers. Let us say, for example, ICAI has collected something like 2000 crores in a particular year in the form of membership fees. Just for example, that much money it will not get. And imagine it has spent around 1500 crores towards the member activities and 500 crores is surplus. Now the question comes, is that 500 crores considered as an income? Should it be taxable in the hands of ICAI? Answer once again is no. Why? Because when members are contributing to ICAI, they are not contributing to some other third party. They are contributing to themselves. It is just a common pool. It is just a common fund which is there for the benefit of members. So the annual membership fees which is paid by the members of ICAI to ICAI cannot be considered as income of the ICAI because the concept of mutuality applies there. Once again, I am warning you, am I talking about the practical position of ICAI and its incomes? Answer is no. We are talking as an example. ICAI is only an example. As an example, if you take any other organization, I could have taken X as an organization, Y as an organization. Just because we can understand easily, we are taking ICAI as an organization. So, like an organization, something like ICAI, a professional membership body, which is having a lot of members and members are paying the fees annually or some other periodicity as the case may be. When it is collecting the membership fees and it is spending some money naturally on its activities, still if there is any surplus, is that surplus a taxable income? Can that be called as income? Answer is no, since there is a concept of mutuality between members and the institute. So effectively what the law says is, if the members are contributing towards the institute, they are not contributing to any third party, even though legally they are not one and the same. Once again, Income Tax Act mostly looks at the substance over form, mostly looks at the reality over legal form. Legally, ICAI is altogether a different person, members are altogether different persons. Still, in a sense, when members are paying membership fees to the ICAI, it is as good as they are paying to themselves. No one can earn income from oneself. That is the rule of law. That is the thumb rule which is followed in the principle of mutuality. So that can be written also by you. As a part of the answer to this question, you can write, no one can earn income from oneself. You cannot earn income from yourselves. Not possible. You have to earn income from somebody else. So ICAI and members are one and the same. Effectively. Legally they may not be same. But effectively ICAI itself is members. Members are ICAI. So that is a mutuality between ICAI and members. And since there is a mutuality existing, any surplus that is generated by ICAI out of the fees that it has collected from its members shall not be taxable, shall not be considered as income at all. That is the concept of mutuality in a nutshell. Now, that does not mean automatically I will apply concept of mutuality and say that my income is not taxable. Once again I am telling you, the concept of mutuality is only a concept. It is a general principle. Automatically it cannot be applied to any organization, including ICAI, because it was only an example. And any organization cannot automatically say, because there is mutuality, I am not going to pay tax. It has to be proven, it has to be accepted by the department, and not only that, if there is a dispute, ultimately it will be proven in the court of law. So practically there is a lot of difficulty in proving the concept of mutuality. However, imagine if all the concept of mutuality has been proven. Once it is proven, yes, there is no need to pay any tax on such incomes of the organization, since the organization and its members are almost deemed to be one and the same. And since both are same, since one cannot earn income from oneself, there is no income that is being generated by the organization. We cannot call that as a nature of income. It is not in the nature of income. Since it is not in the nature of income, naturally it cannot be taxed. That is the concept of mutuality. Now there are exceptions to the concept of mutuality also in the income tax law. These are mentioned in the law. Exceptions are there. What are the exceptions? First one, income of a trade, professional or a similar association by rendering specific services to its members. That shall be taxable. Means that is where the concept of mutuality is not applicable. If the concept of mutuality is applicable, then income is not taxable. since it is not having the characteristics of income at all. However, if the concept of mutuality has an exception, that means income is taxable, since the concept of mutuality is not applicable. One of such cases is trade, professional or other similar associations where they are rendering some specific services to the members. In that case, any income generated by such association shall be taxable to the extent they have earned by rendering specific services. Now we can take the same example of ICAI and continue this. Earlier we talked about the annual membership fees, since it is contributed by every member to ICAI, and since if anybody is contributing to ICAI, effectively it is as good as he is giving to himself, because both are one and the same. It was not taxable in the hands of ICAI. I am reminding, it is an example, not reality. Now imagine ICAI is conducting a seminar and asking all the members, whoever is interested, to attend that seminar. Maybe it is conducting a seminar in a 5-star hotel with an individual entry fees for each member, let us say 5,000 rupees for 2 days of seminar. Like this, let us say there are some 1,000 members which have enrolled for that seminar, and all of them have attended that seminar for 2 days, and 5,000 into 1,000 members. So ICAI has earned effectively, so 100,000 is 1 lakh, 1,000 is 10 lakhs, 5,000 is 50 lakhs. So around 50 lakhs rupees the ICAI has collected, isn't it? So when ICAI has collected 50 lakhs rupees from its members, did it collect it for general services or specific services? The answer is specific service. What is that specific service? Conducting a seminar. Then on the other side, let us say when ICAI has conducted its seminar, really the expenditure of booking that 5-star hotel, lunch, tea and whatever the fees or remuneration given to the seminar instructors, all the things put together, let us say as an example, total expenditure came to only 30 lakhs. ICAI has collected 50 lakhs and it has spent 30 lakhs. So there is a profit of 20 lakhs, surplus let us call it. Question once again is same, is that taxable? Can that be considered as income? What is the answer now? The answer is yes, it is taxable. Why? Because the concept of mutuality is not applicable, because it is falling in the exceptions category. It is a professional association rendering a specific service to the members, not a general service. Annual membership is a generic subscription. Conducting a seminar is not a generic thing. It is a specific thing. Whoever is interested, they only will pay. Other people will not pay. So, when any trade, professional or any other similar association renders specific services to the members, then such surplus generated is taxable, since it is still considered as income, since there is no mutuality applicable in that circumstance. This can be understood as part of concept of mutuality and its exceptions. We can take another example also on a general basis. Imagine, let us say there are some of the clubs that we have, say Hyderabad Club, Secunderabad Club, Nizam Club, etc., etc. They also collect annual subscription, annual membership fees from the members, and they spend that on various activities of the club. So for the club, can the annual membership fees collected from the members be considered as income? Answer is no. Once again, why? Because the concept of mutuality applies there. Because the club and members are not different. Club is made of members only. So when members are paying annual subscription to the club, they are paying to themselves effectively. So even after spending the money for certain club activities, if there is a surplus, that cannot be called as an income, that cannot be taxable in the hands of the club, since it is not even an income, since it is coming under the purview of concept of mutuality. On the other side, the same club, let us say, is conducting a 31st December party, and for that party it has printed some passes and it has printed some tickets, and it has sold these passes or tickets to some of its members or some outsiders also. Basically, the club is conducting an event on a particular day, and on that event, let us say they have collected 1 crore rupees, but they have spent, let us say, only 70 lakhs rupees, and they made 30 lakhs rupees surplus from that event. And most of that money also, whatever they have collected, imagine even if it is from members, Even in that case also, will that 30 lakhs be taxable? Answer is yes in that case. Why? Because it is a specific service to the members. So the generic service to the members, general annual membership fees is not taxable. Any surplus generated by way of rendering specific services to the members is taxable. So these are only few examples. Like this, the list can be endless. And once again, I request all of you not to have any imaginations of what are covered under the principle of mutuality and what are not covered under the principle of mutuality. Don't do that. No need to imagine anything, because that is a legal decision which the department as well as the courts will have to take, not you and me. So whatever we have taken as an example, those are only examples, be it for ICI, be it for a club. That does not mean I am making a statement that ICI does not pay income tax. That does not also mean I am making a statement that Nizam Club will not pay income tax. That is none of our business. That Nizam Club will take care of, ICI will take care of, their chartered accountants will take care of it. Don't worry about that thing. We are taking them as examples so that we can understand the provision easily. The provision is very clear. If there is any concept of mutuality, then nothing is taxable. And if there is no concept of mutuality, one of such exceptions is trade, professional or other similar association rendering specific services to the members. That does not form part of concept of mutuality. Also, there are certain businesses which have been excluded from the concept of mutuality. Simply, you can just remember these two words. One is insurance, second one is banking. So, insurance business is excluded from the concept of mutuality. So, if at all, insurance business is carried on by a mutual insurance company, even by a cooperative society, still that does not form part of the concept of mutuality. Means what? The income of such mutual benefit insurance company or a mutual benefit insurance cooperative society will be taxable. That will be considered as income. That is for sure. So insurance business is excluded from the concept of mutuality. So it cannot claim mutuality if that is doing insurance business, even if it is a cooperative society or a mutual benefit insurance company. Same way, banking business is also excluded from the concept of mutuality. We know a lot of cooperative banks will be there which are having members, and members and bank are one and the same. Can we argue like that? Answer is no. Why? Because the law has clearly excluded banking business from the concept of mutuality. So those who are providing the credit facilities which are in the banking business, or even by a cooperative society which is doing banking business with its members, that is not covered by the concept of mutuality. So what are the broad exceptions? There are three exceptions only. One, trade, professional or similar association rendering specific services to its members. No mutuality. Means income is taxable. Second, insurance business where the cooperative society or mutual benefit insurance company is there and it is doing insurance business, then there is no mutuality. Means what? Income is taxable. It is considered as income. Same with banking. If there is a cooperative bank or a bank which is rendering credit facilities to its members only, even then they cannot say all members are one and the same, bank and members are one and the same. All that logic cannot be applicable to a banking business. So insurance business, banking business, specific services to members, these three are exceptions to the concept of mutuality. Other than these three, normally the mutuality is not taxable. That is another concept of mutuality, very important in theoretical perspective. Next, in the examination, please don't write these examples, only write the provision. Whatever is there in that box, that is what exactly you have to write. Whatever is there in black and white, whatever is there in the material, that only you should write. Examples are once again only for understanding purpose. So please make this distinction very clear. Now coming to another thing that we have not discussed in the earlier class is tax-free income. Tax-free income, is there anything like that? Do we have any concept of tax-free income? Answer is no. There is nothing called tax-free income. Every income, whatever is taxable under the Income Tax Act, automatically is taxable. Then how there can be any tax-free income? That is not possible. So, when we say tax-free income, it is not actually tax-free income. It could be the income, the tax on which has already been paid by the giver of such income. Now we can understand this once again with an example easily. Imagine there is an employer who is telling that he is offering a tax-free salary to his employee. Now the question is there anything like tax-free salary? Answer is no. Then why does the employer say he is offering tax-free salary? Is he lying? Legally yes, practically no. Why? Because what does he mean effectively is whatever the tax liability of the employee, that is also going to be borne by employer. That's what he means. In other words, the employer is not only giving salary to employee, in addition to that, he is also bearing the income tax liability of employee. Then he is telling the employee, boss, you don't need to pay any tax, I will take care of your tax also. Does it make the income of employee not taxable? Answer is no. Because once again we have to go back to the basic essence of direct tax. The responsibility of paying and bearing the direct taxes lies on the person who is earning the income. In this case, who is earning the income? Employee. Who is giving the money? Who is giving the income? Employer. So whose responsibility it is to bear the income tax? Ultimately employee. Just because there is a contractual arrangement between employer and employee and employer is bearing the tax liability of employee does not relieve the employee from his legal liability. He still is liable to pay tax on the income that he has received. Is he going to pay once again the entire tax that the employer has already paid? Definitely answer is no. But who is ultimately responsible for the overall tax liability of the income that is earned? Simple logic, the income earner. He is the sole responsible person. Even if the giver of the income, even if the payer of the income has borne some portion of the tax liability of the payee, that does not make it tax-free income. That is a point to note. There is nothing called tax-free income. So, what is the tax-free income generally referred to as in reality is any income on which tax has already been paid by the payer of the income. Then they call it tax-free income. That does not make it really tax-free. Already the tax is paid on such income. So it is like a tax prepaid. Before even giving the income, the tax has already been paid by the payer. In that case, that's what is tax-free income. Or not necessarily the payment. Even if the payer, in our case employer, agrees to bear the tax liability of employee, even then that income cannot be called as tax-free income. It is only an income the tax liability of which is borne by payer. So better than using the word paid, tax is borne by the payer. If that is the agreement between payer of the income and payee of the income, then popularly such income is called as tax-free income. That does not make it really tax-free. That income is still taxable in the hands of the recipient, that is payee. Now the question comes, how much will be the taxable amount in the hands of the recipient? Of course, the income that is received how? Net amount plus the tax paid on such income by the payer also. So the point is, since the payer has paid the tax liability of payee, the amount of tax paid by the payer on behalf of payee is also income of the payee. That should be added to the income of the payee. That is the crucial point here. Because normally speaking, what is an income? Benefit. Payer is giving some benefit to payee. That benefit could be in money form and any other form. Of course, payer has given some benefit in the money form. Say in our example, salary, employer has given to employee. No problem, definitely that becomes taxable in the hands of employee. That is very clear. But we are talking about the other part. Not only salary, the employer also has borne the tax liability of employee. Means, employer has paid the amount of tax which is supposed to be paid by employee also. In other words, did employer give any benefit to employee or not? Definitely yes. Is that in the nature of income or not? Again, answer is yes. Should that be added to the income of the employee or not? Answer is yes. So these are the points to be noted in relation to tax-free income. So point is, there is nothing called tax-free income. When people say tax-free income, they are only talking about the income on which the tax is going to be borne by the payer. That is the only meaning of tax-free income. That does not mean really the income is tax-free. There is nothing called tax-free income. However, on the contrary, when calculating the taxable income of the recipient, we have to not only consider the amount that he has really received from the payer, in addition to the amount he has received, we should also include the tax that has been borne by the payer, since that is also a benefit given by the payer to payee. Though not directly to payee in the form of cash, it is payee's responsibility and payer is meeting it. That is a benefit. And that benefit is also in the nature of income. So, we can conclude like this. The tax payable by the payer on behalf of the payee is also income of the payee. Once again I am repeating. The tax payable by the payer on behalf of the payee is also income of the payee. And if you are confused with payer-payee thing, let us take example. There it becomes easier. Imagine the tax payable by the employee is borne by the employer. Then such a tax which is borne by employer also becomes income of the employee. In addition to the salary, anyway, what he normally receives from his employer. So that is what tax-free income means, and the treatment of the tax payable by the payer is simply adding it to the income of payee. Now, when the payee ideally and ultimately has to pay tax, of course, whose responsibility it is to pay tax finally, nobody can shift that responsibility onto another one. Only the income earner is the liable person, legally speaking. So after all this happened, finally when the time has come to pay the tax, and the income which has been calculated like above, on which the tax liability has been calculated according to the rates of tax, will the payee once again pay the entire tax? In our case, employee will pay the entire tax once again. Why should he pay? He doesn't have to pay the entire tax. Whatever the tax liability, first we should calculate that. From that, we should deduct already the tax which has been paid by employer or payer. So, that is the point here. Also it is mentioned. However, tax paid by the payer of income shall be deducted from the tax liability of the payee. So, if the tax liability of the payee is calculated and finally before it is being paid to the government, already the tax which has been paid by the payer on behalf of payee shall be deducted. Why? Because it is already paid. Ultimately, who pays to the government doesn't matter. Whose responsibility it is? Always income earner. Who pays the tax? Government doesn't care. Whether the income earner pays the tax, whether the income giver pays the tax, who cares? Doesn't matter. Finally, government needs tax. Finally, when the income earner has a tax liability, it is his responsibility to pay that. If a portion of that has already been paid by somebody else, that amount has to be deducted. Remaining amount will have to be paid by our SSC. In our case example, the employee has to pay that. In any other case also, we don't have to restrict it to the example. If there is any payer of income and receiver of income, the payer of income, if he pays any tax on the income of the receiver, then the amount of tax that is paid by the payer of the income can be deducted while computing the final tax payable by the receiver of the income. So, that is the last step. Before paying the net amount to government, whatever tax has already been paid on our behalf by somebody else can be deducted. However, while calculating the income of the receiver of income, the amount of tax paid by the payer shall also be added, since it is a benefit given by the payer to the receiver. That's what is tax-free income. Understand this very carefully. Two parties are only there, but what is happening, you have to understand the transaction carefully. There is a giver of income, there is a receiver of income. The giver of income is bearing the tax liability of receiver of income. And what we are talking about? Even that is income of the receiver. That should be included in the income of receiver, because it is a benefit given by the giver, in addition to the other benefit anyway he is giving. That is first point. Second point, while finding out the amount payable by the receiver to the government, the amount which has already been paid by the giver shall be deducted. That's the essence of tax-free income, though the word is not legally correct. These are the various aspects in relation to features of income as we discussed yesterday and today. Today the key aspects are, one is the concept of mutuality, second one is the concept of tax-free income. Now let us continue with another concept. This is also a theory question which was asked earlier. What is the difference between diversion of income and application of income? Is there any difference? If so, what is it? And what is the difference in tax treatment of that? This is the theory question which was asked earlier. Again can be expected in the examinations. Distinguish between diversion of income and application of income. There is a separate image which has been sent to you earlier in the group. Open that. Then you can understand distinction between diversion and application. First of all, let us look at the definition of diversion of income. When we can call something is a diversion of income. When income is diverted before it accrues to the SSC due to overriding title. This is an important word we should write in exam. Stories, examples. They may be useful in understanding but not useful in obtaining marks. How to obtain marks? We need to write the correct terminology. And what is the important term we are talking about? When it comes to diversion of income, overriding title. So, one income is earned by the SSC, but before even it accrues to the SSC, that has been given to somebody else because that somebody else has overriding title on such income. In that case, we call it diversion of income. And can that be taxable in the hands of the SSC? Answer is no. It is not taxable in the hands of the SSC. Take an example here. For example, there are three people A, B and C and all the three are co-authors of a book. Imagine. And the entire royalty of 3 lakhs rupees is received by A according to the agreement with publisher or whatever it is. But A alone has not written the book. A, B, C have written the book together. In that case, B and C have an overriding title on the royalty that is going to be received by A even before A has received the 3 lakhs because B and C are also co-authors of the book. That means A, when he has received 3 lakhs rupees, that entire 3 lakhs rupees does not belong to him. Out of that, 2 lakhs rupees, imagining all having equal share, has to be diverted. Of course, he has to give 2 lakhs rupees to B and C. So how much will be taxable in the hands of A? Only 1 lakh rupees is taxable in the hands of A and A has to pay 1 lakh rupees each to B and C. Then how much is taxable for A, how much is not taxable for A? That is what we have to be clear. 1 lakh rupees which is related to his portion of the income is taxable in the hands of A, whereas 2 lakhs rupees which he has diverted, though he has received it, it does not belong to him. It belongs to whom? It belongs to B and C. Because B and C have a overriding title on that income even before A has received that income. Even before A has earned that income. So that is what is called overriding title. So by nature of the agreement between A, B and C, they are all co-authors, which means each of them is eligible for 1/3 share in whatever the royalty that they are going to receive. Means each of the others has overriding title on such income. So A alone cannot be called as the one who has earned 3 lakhs. He has in fact earned only 1 lakh. Remaining 2 lakhs cannot be taxed in the hands of A since it is now called as diversion of income. And what is the important point here? B and C have overriding title on the 2 lakhs that they have received. Of course, 1 lakh each. They have an overriding title. They have power on that 2 lakhs more than A. A does not have power on those 2 lakhs, legally speaking. Though he received it, it does not belong to him. Maybe he is just a postman type. Now, when we talk about application of income, it is different. Application of income is that where the income is first earned, then it is given to somebody else. For example, when the income is applied, in the case of diversion, we have to use the word when the income is diverted. In the case of diversion, when the income is diverted, before it accrues to the SSC due to overriding title. But in the case of application of income is applied after it accrues to the SSC due to overriding title. In that case, we can call that as application of income, and that is taxable in the hands of the SSC. So there he cannot say, since the other person has an overriding title, it is not my income. There is an overriding title, but when the overriding title is coming to the other party, it is not before the income is accrued to the SSC. It is after the income is accrued to the SSC. So the basic distinction between diversion and application is, diversion happens before the accrual of income, application happens after the accrual of income. In the earlier example, B and C have overriding title even before A has earned that 3 lakhs rupees. Whereas in this case of application of income, the recipient is not having overriding title before the SSC has it. It is after the SSC has it. Once SSC gets the income, then maybe the recipient has overriding title on that. You can take a simple example like say you have a bank account wherein the employer monthly pays the salary. Let us say there is a person called X and X receives a monthly salary of 50,000 rupees from his employer. And X has already subscribed to certain mutual funds. So monthly automatically from his bank account some 5,000 rupees will go. Same way he has given instruction to the bank telling that okay, pay my current bill automatically, pay my internet bill automatically, pay my telephone bill automatically. Like that he has given standing instructions. So all this put together is coming to 10,000 rupees, let us say. Now, can Mr. X say my income is only 40,000 since actually what I am getting is 40,000 only, remaining 10,000 is just given to somebody else. Can he say that it is diversion of income? Is it called as diversion of income? No. It is application of income. Why? Because first of all he earned 50,000. After he earned 50,000, that money has been applied for different purposes. It could be for paying bills, it could be for investment in mutual funds, or for that matter, it could be for any charity also. Automatically, let us say he says, give this much of money to charity every month to somebody. Does it make diversion of income? No. Answer is still no. That becomes only application of income. So, that is the difference between diversion and application. In our example, how much will be taxable in the hands of this Mr. X? Is it 40,000 or 50,000? Answer is 50,000. Entire amount is taxable because he has earned 50,000. What he did with that 50,000 doesn't matter. That is a point to note in Income Tax Act. We don't care how the income is applied, how the income is spent. There may be somebody, Mr. Y, who may earn 50,000 rupees and throw that money in Hussain Sagar. Can he say I did not earn income? No, boss. You still earned income, you have to still pay tax. After earning income, what you do with that? You just throw it somewhere, you give it to somebody, you give it to charity, whatever you want to do, you just burn it during Bhogi. It is your choice. Nobody cares. Income Tax Act will not care about it. So it cannot be said that I did not earn income. You first earned income, after that you applied it. So application of income is taxable in the hands of the SSC. There cannot be any exception there. Diversion is not taxable because it does not actually belong to the SSC. The income originally belongs to somebody else because that somebody else has an overriding title over the income even before the income is accrued to the SSC. That was diversion of income. In case of application of income, the other somebody does not have overriding title before the income is accrued to the SSC, whereas the other party may have overriding title still after the income is accrued to the SSC. In that case, it becomes application of income. And how is it applied? Where is it applied? How much is applied? All these things become completely irrelevant. Entire amount, whatever is earned by the SSC, automatically becomes taxable. After that, what he does with that? After that, where he applies that? It is all completely irrelevant. So, that is application of income. And look at the example which is given here, which is similar to the one what we have taken. If an employee instructs to his employer to pay a certain portion of his salary to a charity. In the same example what we have taken, say employee Mr. X gets 50,000 rupees from his employer and he tells his employer, boss, don't give me 50,000 every month. Give me 45,000 only. 5,000 rupees you directly pay to a charity. You don't even give it to me. You directly pay it to a charity 5,000. Give remaining 45,000 only to me. If employee says that to the employer, then can we say that other charity has an overriding title on this 5,000 before it is earned by Mr. X? Answer is no. That is why. Can we say it is diversion of income? Answer is no. So what should we say? We call it application of income because the SSC has first earned 50,000. After earning it, where is it spent? Is it spent on charity? Is it spent on something else? Something else? It does not matter. Hence, how much is taxable in this example? Entire 50,000 will be taxable, not 45,000. That is the difference between diversion of income and application of income. Right? That is the conclusion of these features of income or the concept of income, we can say. So with this, we can almost conclude the concepts and definitions part of this particular chapter. So with an overall understanding of what are the basic aspects which are required to be known for further study of Income Tax Act. We are going through them. So with this, almost we can say the major content, 99% of this chapter, the chapter 1, the basic concepts and definitions is done, and we'll conclude the today's session with this. And in the next session, we'll discuss couple of more small things which are remaining, and one more time we will just have a quick revision of all the concepts and definitions, what we have learned, and we'll also check whether we have achieved the learning outcomes which have been outlined in the ICAI material. That we will discuss in the next session. Till then, stay home and stay safe. Take care. Bye-bye. Thank you.